Page. Welcome to Legacy Money. I have my co-host John Webster with us today, and we're going to discuss the news. The news is all about the Fed today, whether or not they will be raising rates. So our conversation is really going to be about, do rates matter? So welcome to the program, John.
Hey, thank you. Good to be here.
Awesome. So how's the weather out there in Arizona? You holding up okay?
Yeah, we're having a pretty good time. The weather's treating us good. We got about 65 degrees, nice and sunny out, and little bit of rain supposed to be in the forecast, but it keeps pushing out a little further out.
Awesome. So John is, in case you haven't seen us together before, we've done quite a few of these, but John is my fellow IBC practitioner, and we're going to try to shed some light on the interest rate. So, of course, rates have been threatening to go up, and now people seem to have been banking on rates going down. What are your thoughts on initially, John, before we kind of get into what happened today?
Well, we've seen the rates go up and up and up and up over the last couple of years, and the Fed has they've got a job that they're supposed to be controlling inflation. They're supposed to be controlling jobs or unemployment rates. They're supposed to be controlling the market or the economy, right? But we've seen those rates go up. We've seen it improve some things in some sectors, and we've seen it harm in a lot of other sectors. So people are pretty anxious about the rates because to some it really makes a difference, right?
Certainly.
So there are some market sectors that are pretty crippled due to the rates, and there are some in the economy that the higher the rates go, the better it is for them.
Yeah, absolutely. It depends on which side of the fence you're on, or the Great Wall of China,
right?
As our mentor Nelson Nash used to say. But the funny thing is, when you look at rates, and here's a chart from the Federal Reserve, the Fed effective rates, and this dates back to a long time ago, 1955.
Yeah.
And you can see rates pushing 20% here during the 80s. So
yeah,
if you came along after 2000, right around here, you're probably not feeling too good now about rates. But just want people to understand, since the Federal Reserve, let's just call it, manipulates these rates, they've been much higher than they are today. What are your thoughts on that, John? Have you experienced that?
Yeah, they have been much higher. I mean, if you look back at the 1980s, that was some of the worst interest rate environment in our country's history. And one of the reasons was that it was also a period where inflation was running rampant over the country. There was banking crisis. There was kind of a free fall in the stock market. It came unglued. So there was kind of blood in the financial markets at every which way you turned, and the interest rates kept ratcheting up, trying to bring some things into under control, and it just kind of helped to make matters worse, and a lot worse in some ways, right? You're mute.
You mentioned thanks. You mentioned a few things in there. You started out kind of talking about the Fed's purpose, and I've gone over that till I'm blue in the face. But the Federal Reserve, as we know it, was created in 1913, And ironically, the same year that the IRS 16th Amendment and all this went through to pass that. But really, I wanted to kind of bring it home today. This is what Chairman Jerome Powell said today. He said, "Let's be real. This is a good economy." That's a direct quote from him in the meeting today. And I don't know how they're getting away with saying we're in a good economy. Like you said, some people may be enjoying this high interest rate environment we're in, the high inflation rate. I don't really think interest rates are high. Again, according to, if you just looked at the average, from 1970 to 2010, they're certainly not high. And so now we're just kind of getting back up to, where they were just before the debacle, 2008, 2009. But, I wanted to show you something else just so you kind of understand. This was my very first loan in 1988. As you see, just about 112.88, not far from this time. And as you see, the annual percentage rate, 35.84. Now, this was just for a regular loan. I had already I was buying a second car, used vehicle here. But as you see, there's my name there. My mother had to co-sign for me. But 35% interest. Now, I know even today, some people are paying upwards of 35% for credit cards, right? And that's really kind of the issue. Nelson said that the volume of interest is the real issue.
Yeah.
So can you speak to that a little bit? What does he mean when he says the volume of interest is the real issue?
So Nelson talks about the volume of interest, and he says that rate really doesn't matter. It's the percentage or volume split that you're giving away to the banker compared to that you're paying towards building or paying off an item or building equity in an item or a house or a car or paying down that debt for something that you made or purchased. And if you're giving away a payment of, say, $1,000 and 35% of that $1,000 is applying towards interest and 65% is applying to principal, the volume of interest that you're giving away and forfeiting is 35%. And that could be on a 5% interest rate or a 6% interest rate. If you look at the volume of interest on the mortgage, the bank is keeping a very big volume percentage of the payment that you're making. And that's largely because of how amortizations work. They're scheduled to pay down over time, so they're very loaded on the front end. You're paying much higher volume in interest compared to at the back end when the principal gets reduced dramatically.
And that's a good point. So let's kind of bring it home. So this is a chart right out of the book, Becoming Your Own Banker, but of course it's in color here to highlight the red is the interest, the green is the saving. And Nelson said he was being generous with the 10% of income, being saved, which, those savings rates are probably even less than that, but being generous. And he noted that 34 cents of every dollar that the average American spends goes to interest. And so that's what this is showing. Maybe you've got a car loan at 5% or a mortgage at 5%, right? But what he's talking about, what you just said on housing, over time, that volume adds up. So even though the rate might seem low as a percentage of volume over time, that's what he's talking about. Mm-hmm. And so the volume of interest is the real issue. And so some people might say, well, I pay cash for everything. So, I don't finance. So what do you have to say to that, John, when somebody says I pay cash for my cars, or, I don't use a credit card, or I pay it off every month?
Well, paying cash, that's great if you listen to some radio personalities. The challenge with paying cash is, I always tell our clients that you finance everything that you buy. And so when you pay cash, you're actually forfeiting the ability of those dollars in cash to ever work for you in your lifetime again. And so you're losing the ability of those dollars to earn interest and perform a job for you by paying cash and disbanding them from your employ. And so paying cash sounds good, but it may not be the best.
Yeah, absolutely. And so it kind of falls back to, are you saving money, first of all? And then secondly, what is your debt situation, right? So I wanted to kind of talk about debt here for just a minute. And if you look at this is the debt balance of Americans, over the past 20 years. And as you see, it's been going up and up and up. So the blue line is housing debt, and then this is other debt. So things like credit cards or car loans or whatnot. And as you see, they're only increasing. And so, student loan debt now over 1.5 trillion, credit card debt over 1.5 trillion dollars. But also the government itself is in debt.
It's
okay.
debt.
And that debt is, the yearly is $34 trillion at this point. If you want to go check that out, go to usdebtclock.org, and you'll see that, the debt is approaching it is a $34 trillion. So just the interest, back to kind of the interest rates matter. Yeah, interest rates matter to the government and who's the government? Well, we, the taxpayers. All right. Mm-hmm. So people are already estimating that the interest this year alone will be $1 trillion. That's insane. For the last few years, it's been, 300-400 billion, right? So $1 billion a day just to interest. But now it's going up to $1 trillion. So it's about $3 billion a day, just to interest. So think about that for a minute. What about the government debt? Does that matter? Do interest rates matter? And why do you think that the Fed, didn't make a decision today to go up or down? They kept them level, is what they said. So what speak to that a little bit, John?
Well, they give a lot of reasons. They give a lot of talk. They give a lot of double talk.
Yeah.
Well, we don't see that inflation has come down enough. We don't see that the economy is doing good, but it's not as good as we would like. So therefore, we've got to keep on holding the course of the same inflation. We think that we've got things in hand, but we aren't sure, and we just need more time to prove out whether we're right or we're wrong. I mean, everything that they say is backed up by doublespeak, and so when you look at the Fed, you first got to go back in history to 1913 and understand that they aren't at all federal, right?
Yeah.
So that most people don't even realize who the Fed is. 1913, that it was cooked up by a bunch of globalist bankers, but they're manipulating the markets. And is it good for us, or is it good for them?
Yeah.
If there's a $34 trillion debt, where does the interest on that debt go to?
Yeah, that's a good question, right? And And the 34 trillion of money spent this year, the debt that we do not have,
That's only a piece of the puzzle, right?
Right. Yeah. That's not including our unfunded liabilities of Medicare and Social Security, which are well over $100 trillion. And, I don't want to go into how big a trillion is again, but it's a big number, right?
It's a big number.
A
lot of zeros.
1,000 billion, right? It would take 32,000 years if you could count that high, and you could count one per second, right? So that's a long time. But the debt is the issue, whether it be for us or whether it be for the government, right? And the volume of interest over time. And so where does the government get money? Well, the government gets money in only two ways. They don't really produce anything. Anything that they do, Amtrak, post office, they don't make any money, right? And government programs, they just spend money. They're the largest employer in the world. The U.S.
Unfortunately.
Yes.
Unfortunately.
So they've spent the taxpayer. So right now people are filing their income taxes between now and April. The crazy thing is, maybe they're going to collect $5 trillion in taxes this year, but they're again 34 trillion over, right? So where does that money come from? Well, so they print money, inflation, right? And so people have liked it. We've been in this low interest rate environment for so long, but that's what caused the inflation. They inflated the money supply. That's why the cost of goods seemed like they went up, but really, businesses, they didn't really do that. It's the cost of the goods that they supply went up. So they had to raise their prices just to pay their bills. So it's a domino effect across everything. But here's what happened. So for the past, I don't know, since the last Fed meeting, all the markets have been going up, and I can't explain it. Nobody can really explain. How's the economy, the markets doing so good, as Jerome Powell says, right? Unemployment down. Where are these government jobs maybe have been created, or people went back to work after the pandemic, right? And so here we are, but I want to take a look at what happened. So the market's been going up and up and up, and here's what happened right after Jerome Powell said, hey, we're not going to lower rates. And we may not lower interest rates at our next meeting in March. So immediately the markets tanked. Okay. Now that's just today. Who knows? They might come back. They probably will come back. They're probably going to be very volatile, just like they've been for the past couple of months, right? Up and down and up and down. And the question is, are you comfortable having your money in a government plan in the stock market? And if that's your only source to save for the future, you might have a problem, right? And so we recommend and like to talk about another way to use interest rates to your advantage. So if rates go up, right? Well, we're not in a bad position because we're using banking as a process, right? It's not about the product, and the product in this case is life insurance, but we use life insurance the same way that the big corporations and the same way that the banks use life insurance. So speak a little bit about the process for me here, John. Why are we not so concerned about interest rates if they go up or down? Because in the low interest rate environment, aren't savers actually being punished, right, by artificially holding rates down? So if you are saving money not in the market, you're not really earning any money either. So what happens if rates go up if you own one of these IBC type policies that we've been discussing?
Well, if the rates go up and you are in control of the banking process for your family and your business, then you can take advantage of the banking sector by being your own banker, right? And you can take advantage by purchasing capital purchases or investment opportunities and having control over the interest rate environment of your loans. Not only having control over the interest rate environment, but having control over the repayment process and environment of your loans. So, imagine if you're the bank and you're collecting the volume of interest and the principal and able to restack it to reuse again. Does the volume of interest hurt you the same as if that volume of interest is going to the bank downtown? Not if it's coming back to your family, right?
Right. And that's a good point there. So what you're doing with IBC is you're controlling the banking function, right? Instead of putting it in the hands of the banks, the traditional banks, which, the rates could go up. The rates could probably not go down, but they could. And if they go down further, get ready for more inflation, right? And just another bigger bubble. But some companies have fixed rates, some have variable, some let you choose, some let you change it, but it's all relative. Because if a bank has a higher lending rate, they're also going to pay a higher dividend rate. Now, interest rates and dividend rates are two different animals. Sometimes that causes some confusion. But if a insurance company is able to charge, I don't know, a lot of my policies are 8% fixed rate loans, right? But guess what? Those were bought on a block of business when rates were higher. Okay, before they started coming down. They're older policies, right? And now that rates are going back up, those policies, they're still chugging along, performing, even through all the ups and downs of 2008, 2009. Then I've got some newer policies that I got, when the interest rates were lower. And so the dividend rate might not be as high on there, but guess what? I'm also locked in at a 5% rate if I want. Okay. Yeah. And so then that might reduce even lower in the future. So if rates do go up, to 8, 10, 12%, like they have before, 18%, or even, maybe you got a credit card that's 30, 33% is about the average, I think, of some credit cards these days, then you can be the banker and not pay that rate, right? You can pay off your credit card. You could finance your purchases. And, so you're in a better position by controlling the banking function. But why not maybe can you just tell us a little bit, maybe an example of how somebody might use the banking process for an investment, John? I'm not talking about, paying off a credit card. Now, of course, you pay off the credit card, you reduce the debt, and you're not Nelson caught in the snakes and dragons. You don't have them beating down your door. But it takes a while to capitalize, I know, but how can somebody use this in an opportunity? Say rates do go up, there's foreclosures out there, or gold or Bitcoin are going to go up in the future. Maybe there's an investment that's guaranteed to go up or might go up. I hate to use the word guaranteed because life insurance is the only thing that actually has that guaranteed column. But talk to us about what somebody might use a policy for if they were going to use IBC.
In a higher interest rate environment, like, we've been seeing the rates going up, and we've seen it starting to affect, and it has affected the real estate markets significantly. Inventory for sale has been very sparse, and the reason is that buyers are it's very hard for a buyer to be qualified to buy at the prices that had been real estate had been selling for. What we'll probably see if the rates continue to hold is that real estate prices will come down significantly. Maybe we'll start to see some foreclosures because people won't be able to sell when they need to sell, and they'll lose their homes. So there may be some real good buying opportunities. And if you've got the ability to create the loan because you've got capital stored up in an IBC contract, a a life insurance contract where you've got high cash value available, and you can create a loan from the life insurance company and go make a purchase, opportunities are going to seek you out. And so what could that look like? It could look like, you're able to buy a house at 50% of the rate that it used to sell for. And because you've got the ability to create a loan from your banking policy, where someone else would have to go and qualify, and they wouldn't qualify because interest rates have pushed them out of the qualifying parameters. So the pool of buyers, it becomes much smaller, right? I was looking at a house the other day that a friend of mine's selling, and that house is really expensive, right? $4.3 million house. And it was so funny when you see the listing on Zillow, it says the monthly payment will only be $25,000. And you're like, so what person's going to go out and qualify for that loan? Only a cash buyer is going to come in and buy that property, right?
Yeah.
Now, that's an extreme example. Yeah. But what if it were $1 million? Could you really afford the $7,000 or $8,000 payment? Whereas that $1 million home's financing cost a couple of years ago was about a $4,000 payment.
Yeah.
Right.
Yeah. Yeah.
And now it's more than doubled. And so, but what if you are in control of the banking process and you can pull the $500,000 loan from your banking policy and go strike a deal on a place that might have sold a few years ago for $1 million?
Yeah.
And you can finance it and control the banking process.
Absolutely. And, so you're out there in kind of a hotbed, the Phoenix area. I just saw some reports yesterday. I don't know if it's Glendale or where, but it was the hottest, it said, in the country, right? And even in this little small town that I live in, the real estate market is still pretty strong. I mean, it's overpriced is what it is.
It is too high.
But in many parts of the country, they're suffering. Not only real estate, but I mean, just groceries. This is what's hurting people. Inflation is up. They want to tell us that not, but you go to the grocery store now, you feel the pinch. What you used to spend $100, $200, now you're spending $300, $400, $500 at the grocery store, for a week or so to feed your family. It's pretty crazy. So, I don't want to.
Talking about groceries, and so one of the Fed's mandate is managing inflation, right?
Yeah. Yes.
But a couple of years ago, they took fuel and energy and groceries out of the calculation to look at the factors of inflation. And so, like you're talking about, we've seen groceries probably almost double in the last couple of years, haven't we? And we've seen, if we go out to eat at a restaurant or a fast food place, it's more than doubled in the last couple of years.
Yeah.
And they aren't factoring that into inflation. They're like, oh, that's kind of, fuel, energy, groceries. That's not a part of the calculation.
Yeah. So it's pretty crazy, but shifting gears a little bit, I brought this chart back up here just to kind of explain again, the volume of interest is the real issue. So if we don't have to finance with credit cards, if we don't have to finance with banks, if we can recover that money, right? And boy, we lost you there, John. I hope John comes back, but we can recover that money. And it's that's what the banking process is all about. It's if you could take this 34 cents that you're spending right now, and I know it's hard to get across. Nelson called it the Great Wall of China. But if we can start saving, and of course we might not be able to save 30%, but if you can save 10 or more, then you're going to be in a lot better position. And if you can run those purchases through your system, your banking system, instead of the bank. Let me see if we can get John back on here. I'm not sure what happened. But he's gone at the moment. Hate to refresh, but maybe he'll come back. So we're talking about the volume of interest. And let's just say you don't have any debt, though. You have opportunities, and maybe those opportunities are coming along. Maybe it's real estate. Maybe it's something else. Wherever it is, the stock market that you want to invest money, because we're talking about saving versus investing here, a big difference. But opportunities will come along. And if there's an opportunity to buy something and you have access to capital, maybe it's the down payment. Maybe you're buying a $200,000 property and you've saved up $20,000, $25,000, and you could run that down payment through your system, right? It will take you a long time to be able to purchase, a house or a property outright, unless maybe you're getting a good deal, a foreclosure. But if you've got capital saved and it's liquid and it's earning a return, and then when you pay back the entity that you borrowed from and it goes back into your system and you have access to the capital again later on, then you're going to be well ahead of the game. So we're talking about the banking process, and we were talking with my good friend, John Webster. So I'll show you his information here. If you need to get in touch with John, it's john@mpgwealth.com is his email. His website is mpgwealth.com. So check him out, or please leave your comments if you have any questions about this. We'd love to share it with you. This process here is straight from the book, Becoming Your Own Banker. If you haven't read this book, I highly encourage you to do so. That's on page 26. And it's just a real simple layout of how a policy works. So if you owned a life insurance contract and you wanted to use it for banking, understand that the premiums all go into this pool that the life insurance company, and we deal with mutual companies, so the company itself is owned by the policy owners, right? So as the company makes profits, which they do, and they have, the companies we work with for over 100 years, they will pay a dividend. Dividends aren't guaranteed, but once they're paid, you can't lose the dividend. And again, if a company has been paying a dividend for 100 years solid through the Great Depression, through all the recessions, up and down, it's a good chance they're probably going to continue to pay it. That pool of money has expenses. They've got to pay the hired help, the people that work there. They've got to pay death claims from time to time. They make loans, right, for joint ventures, for mortgages, commercial mortgages. They're not really into this repo market and these bad loans, right? Life insurance companies are very conservative. They don't like to lose money. But the number one source or access, people that have access to the money in the pool, are the policy owners. So if a policy owner makes a loan and a repayment, just like the joint ventures or these commercial loans, the money goes back into the pool. The money is accessible again later on down the road. So that's in a nutshell how the process works. You can get into all the numbers. We can examine your situation. Everybody's situation is different, but if you want to learn how to control the interest rate yourself, say maybe you've got a loan at 5% and you want to repay at 10%, there's ways to do that. So you get that extra money going back in that would go directly to your cash value in the policy. So we're talking about a dividend paying whole life insurance contract from a mutual company. And you can own one of these yourself, the same way that the banks own them, the same way that the large corporations own them. So Thank you for joining us today. I'm not sure what happened to John, but if you need to get a hold of him, you can. My information will be at the bottom. We hope you'll subscribe to our channel, whether or not you're watching this live or you're watching it on the replay. Thank you for joining us. And if we can ever help you, if you got any questions or comments, just leave them below. And hopefully we can help you become your own banker. Have a great day. We'll talk to you soon.